Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finni to refinance their home loans. Call us now on 1300 002 023 and find out what you could save, or visit our website finni.com.au to book an appointment.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Recording in January, everything's happening, back at work, getting stuff done. Thanks for tuning in over the break. Downloads on the Smart Property Investment Show, the Property Investment Podcast, now we're through the roof. So looks like a lot of you spend your time tuning in and what's going on in property, and it's good to see that connectivity, people using that time at the break to get stuff done. I'm sort of spending a bit of my time at the moment. You would have heard and tuned in that going through a refinancing process at the moment with the Smart Property Investment Portfolio, what we sort of cover on this. So I'm sort of spending my days working out my interest rates at the moment. I don't know whether they're going to go up in February. Maybe we're going to have a chat about that today. But what bothers me about administering a largish property portfolio is that it takes a lot of time, energy, and effort. Sometimes I just can't be bothered. So I've just got to get into it. So stay tuned. We'll get into that moving forward. But I wanted to get into property markets. Let's baseline what 2023 is going to look like for property. You pick up any paper, they'll tell you there's still a long way to go for properties to bottom out in terms of pricing. Whether I subscribe into that or not, it's a matter of conjecture. Maybe we can get also into that today. Depends where you choose to consume information, and how you choose to consume information will frame your lens on property market. But someone that knows a fair bit about this sort of stuff is Damien Collins. He's the Managing Director of Momentum Wealth and the Chairman of Westbridge Funds Management. I think we had a podcast with Grace Hornsby, Editor of Real Estate here at Momentum, running up the Chrissy, our top 5 podcast. And I think Damien was actually one of them. So he does resonate with our listeners. So it's good to have him back, have a bit of a yarn. One of his former roles was he headed up the Real Estate Institute of Western Australia as well. So he's used to talking on the radio and on podcasts. He might be a bit rusty. I know he's been on holidays relaxing. So we'll see how he goes. Damien, how you going?
Oh, I'm good, Phil. I'm back at work for a couple of days now, so hopefully the rust has come off and I'm ready to go.
Ready to go again. So time away with family on a beach, taking it easy.
Yeah, not just went to a holiday house about an hour and 15 away from home, so that was nice and good to spend time with the family and just to. I left I didn't clean my desk. The last day of work before Christmas, I did that annual thing. I cleaned out all the papers, actually found a lot of dust on there too, which was a bit disturbing, but I cleaned so I came back to a fresh desk. So nice break and certainly ready to go. Looking forward to 2023. Yeah,
it's good. I'm actually the opposite. I left my office reasonably messy, and these are the first 2 days of work for me. And like I spend the time cleaning my desk because it's sort of, I don't know, just some sort of chemical reaction it does inside of it to reset and recalibrate, which I think a lot of people are doing around property at the moment. I sort of made reference to some of the dire predictions you're still reading in the media, which get a bit misconstrued, I think, by certain elements of the press. But give me a sense for 2023. Is it going to be a good time to be a property investor, Damien?
Look, it is going to be challenging, Phil. There's no doubt about it. The interest rate rises we've seen have been fairly rapid and proportionately. Don't forget, it was only 8 or 9 months ago that we were all paying 2.5% to 2.8% on our mortgages. Well, now most of that's going to be at least 5%. So you don't have a big run-up like that without some pain. The good thing is, of course, though, that people forget, and a lot of these commentators forget, is that the banks already had buffers, quite substantial buffers in their modelling. So when you got a loan for 2.5 to 2.8%, they were still modelling that you could afford the loans even if it got to that 5 to 6% range, depending on the lender. So, and not only that, the COVID period, people stashed away a lot of cash. They put away a lot of money. And so we had 250 billion or thereabouts in savings floating around in the banking system. So people come into this downturn fundamentally in pretty good shape. But look, when you have a big run-up like we did during COVID, and some markets are going to come back. But property is not just about interest rates. Interest rates is certainly an important part, but a lot of the markets around the country are certainly more impacted by jobs and opportunity. So if the job market's really strong and people are employed, you find delinquency rates for sales, even if interest rate rises, are negligible. And the big X factor, I think, for this year is population growth. So most of, if not all, the major centres around Australia have a critical rental shortage. Our rental vacancy rates are very, very low. And also housing supply has increased in some markets, still low in other markets. But if we get the earmarked 235,000 people that they say are going to come, that's an awful lot of housing. So that will, in first instance, put pressure on the rental market because most migrants will come in and rent first. So that'll keep that ongoing pressure. And so rents are likely, I think, still to continue to rise every major market around the country. But ultimately that flows through rising rents. Tenants go, well, this is expensive, I'm going to come and try and buy. So some will, not everybody can afford to. So I don't buy into the doomsday. Yeah, it could go down a bit more. We've seen Sydney and Melbourne and Brisbane cop the biggest hit, but they were also the biggest rises during the downturn, and particularly Brisbane. And they're the most expensive markets, so they're going to be more impacted by interest rates. The lower priced markets, Adelaide still went up 10% last year, Perth did 3.5%, 4%, and Darwin is still going okay. Adelaide's come back a little bit in the last quarter, but Perth and Darwin are still going ahead, albeit pretty moderately. So I certainly don't buy into the doomsday. I think, we're likely to see, unless unemployment went up dramatically to 7 or 8%, which I don't think it will, and where we saw a lot of false selling. But if we see a bit of a spike in unemployment up to, maybe 4.5%, and I think the interest rates, they probably should stop now, but they might go 1 or 2 more. So yes, in summary, I guess, yes, the big markets could come down another 3 to 6%, who knows? But the smaller market's probably going to hold, and I think there'll be a sense when people realise that's the end of the rate rises, and next one will probably be down, either late this year or sometime in 2024. That'll restore a bit of confidence again, I think, as well. So for a property investor, look, everyone would like to buy the exact bottom. I don't think anybody, doesn't matter how much of an expert you are, gets that right every time. I bought a few right at the right stage of the cycle, but not every property. And so I think, if you're looking to get in the market, there's going to be some good opportunities in every capital city this year. And obviously in the bigger markets that are still dwindling down a little bit, you probably don't have to go and buy it tomorrow and rush. But, I'd certainly be looking around if I was buying in Sydney, Melbourne and Brisbane, because the next 6 months will be where that market gets towards that very bottom.
So quite a lot of moving parts there, Damien. And I sit there and I think about my own portfolio and then for all of our listeners, and the conversation's always about how much your property's gone down or how much your property's gone up. People don't really like to talk about their properties going down, but they're really happy about talking about when their properties go up in value. But my big question is, if you are a property investor and you're holding real estate assets right now, and what does it matter that properties have come back in value? What is the true impact on a property investor as a result of that? If you're not transacting in property, if you're not refinancing that property, it's largely no consequence.
Oh, you're right. It's an emotional reaction rather than a logical reaction. Yes, we'd all like our properties to go up and never go down. Well, that's not the real world. They're always going to, in a cycle, once every 4, 5, 10 years, they're going to come back a little bit. But historically, this is probably one of the bigger downturns we've seen. We're only still talking about 8% nationally. So it's not like the stock market, which can go down 40, 50%. And you're right, like day to day, what's more important is your rent income and obviously your mortgage repayments. That's your cash flow. The volatility in property is, for most investors, shouldn't be much of a concern. The only time it could be an issue is if you're refinancing. I heard you mention you were, and the values come in a bit lower. And if you're really trying to heavily gear, that might have an impact. But certainly for most investors, you're looking at property. You've got to be looking at it as a 7-year minimum venture, in my opinion. The cost of getting in a stamp duty, that horrible thing that we all get whacked with, is 5-ish% depending on the market. Then on the way out, you've got agent fees. So your round trip expenses get 8 to 10%. So you're not trading in and out of a market based on 8 to 10% downturns, which we're seeing now. You've got to see it through the cycle. So I wouldn't be too concerned as an investor. I'm very bullish about the future of Australia. I see all the things going on with the electrification and of the world in terms of the batteries and also the renewables. I think we've just got just an amazing future ahead economically. So if you're pretty optimistic about the future, ride through the cycles and don't let it worry you, because it will come back again.
Well, it says a man that lives out in the state of Australia where you just dig stuff out of the ground and sell it to people. So money's typically pretty good. And we'll have a chat about the WA market in a moment, Damien. And I also want to pick your brains on the commercial markets because I know you're doing some work there. The last time we caught up just before Chrissy, we had a good discussion around the funds management business that you're the chairman of Westbridge Funds Management. So I'd like to check in on that as well. But staying at a national level, Damien, and sort of viewing property through the lens of being an investor, 2-3 major levers that are pulled. That's the value of your property, your ability to leverage against it through mortgage finance, and then how much money you can generate from it. On the money generation side, you should really be looking at your portfolio at the moment because I'm going through the process myself, and I reckon 80% of all my rents are way under market. So I'm resetting them all at the moment, which is hard work, but it can make a big impact, can't it?
Oh, absolutely. And with the rent increases we've seen around the country over the last 2 years, if you haven't adjusted your rent, you could be 25, 30% under market. And we're certainly seeing that here in the West and around the country, that rents have risen rapidly. So that certainly does help offset some of the pain from the extra mortgage repayments that you're making. And as I said a bit earlier, Phil, I'm still pretty bullish on the rental market. If we're getting 235,000 migrants, and there's enough jobs for them. There's jobs all around the country, particularly skilled workers. So if we do get that level of migration, they're going to go in the rental market first. So, that's really going to keep that pressure on the rental market. So I think as a property investor, ideally you've got a great property manager who's keeping on top of these, but nonetheless, you've still got to watch your eggs yourself. It's just imperative every year to benchmark your properties to market. And, some people go, oh, look, I've got a great tenant. I don't want to disturb them. I don't want to put the rent up. But look, a good tenant's worth, to me, $10 to $20 a week at best. There's lots of good tenants out there. And, a tenant's not a charity. If you want to give your money away, put the market rents up to normal and donate to a charity. A tenant shouldn't be your point of charity. So, I think a lot of people out there are listening. If you haven't reset your rents in the last 2 years, you might be pleasantly surprised at how much you'll be able to put them up next time that lease comes up for renewal. And
it's good for you also. And let's remember, this is a podcast for property investors. So it's okay for us to talk about, well, you shouldn't be a charitable. It's not your job to be a charitable organisation by providing housing for Australians. The government does that for people who need that. But the structure of the way in which property investment rentals works in Australia is that, by and large, is owned by individual investors, mum and dad investors. So I always say, don't gouge. It should be what the market rent is. But what I do find, Damien, I like your view on this, is working with a whole range of different property managers for properties that we have across a number of different states of Australia. By and large, and I'm going to call it nearly 100% of them, are uber conservative in rent. So when they do a CMA, a rent review, they always come back saying, I think it should be this. And I go, sounds a bit low. I go away and do my own work and go, nah, you guys are still out of the market. Even though they've upped it by $20 or $30, you go, this should be at least this much. And you have this sort of little debate with them and you go, this is what is available right now at that price for similar properties. That's what it should be. Why do you think they always are on the side of conservative property managers when upping rents, particularly in a market like this?
Look, a lot of them aren't property investors themselves, so they don't quite understand that 90+%, 95% of investors are not the landed gentry sitting on a big property portfolio and it's just loose change to them. It's really important money to a lot of people, and most of them are individual investors, doctors, nurses, police officers. They're not necessarily the top end of town. So I think they're not generally property investors themselves, and they quite understand how important it is to get it to market. And I guess they've also got to manage that father phone call to the tenant who, when you say, no, it's not 20 or 30, it's 50, they're the ones picking up the phone or sending that email saying, oh, we're going to put your rent up 50, and they cop the flack back. So my philosophy on this is let's give it a go. If it's a market review with a sitting tenant, you chat to your property manager. I'm lucky. Obviously, I run my own. All my properties are managed my WA properties are managed by my internal team here. So I just have a chat and we'll say, look, it's markets of range, right? It's not precise science. There's a range. And so we think it's gone up 30. Let's try 50. And the tenant can say, no, I'm not paying that. I'm going to go if you put it up 50. And then you go, okay, well, let's contemplate that. And maybe we would go 30. And or if it's new to market, let's say it's come up as a vacancy. Well, in this market, with the vacancy rates in WA are 40-year lows, and they're pretty similar around the country, very, very low vacancy rates. It's a market to try it. If the vacancy rate was 7%, you probably would just be happy to get a tenant who's paying, paying anything. You don't want to sit there for 3 or 4 months on market. But in this market, give it a go for a week or two at a bit slightly higher rent. And what we're seeing in WA is even if you put it on at market, and particularly on new leases, people are coming in over the top and offering more.
Interesting point that, because I think by memory in New South Wales just before Chrissy, they banned this sort of reverse auctioneering on rents. Like you can't bid up. You're saying, this person will pay this person, and push it up. So I think what that's going to do is just reset all rents at a much higher rate. You can always, I think you're allowed to come down, but you're not allowed to go back up.
Yeah, it's the absolute stupidity of government, Phil. It just boggles my mind. It was a knee-jerk reaction, and you're exactly right. So you can only go down. You can't go up. So everyone's going to go higher. So it's going to reset the rents probably $10 to $30 more a week. So go, well, I'd rather try high and
bring it down.
See where I go. I can always come down. I can't go up. And the other part of it I thought was a bit bizarre is that people can still offer more. So you can advertise it for $500 a week. People can still offer $600 a week, but the agent can't encourage it. So I don't know. I just think governments just constantly tinker and interfere in the particularly the residential market, tenancy market. I saw the Labor opposition in New South Wales is coming up with some what they think are whiz-bang policies to make renting more affordable. It's only going to make it more expensive. It'll just annoy more investors and I believe. So they're not helping. They're making it worse. Yeah,
and I got that right. That was in New South Wales, right?
Yeah, it was.
Yeah. And to be fair, there's been some woeful policies tried to pass through on a property over 2022. The most idiotic one was what the Queensland government tried to do with land taxing Australian investors across their whole portfolio in Australia. Absolute madness. But you can see how, as a property investor, there's a lot of stuff outside of your control. Like you can manage your own cash flow. And we're talking about how you do that by rental reviews and stuff, and how you manage your own debt, whether you've got the right mortgage, the right rate, you can refinance, all that sort of stuff. And that's what we're doing in the Smart Property Investment portfolio with Finny at the moment. There's so much out of your control. Like the government can go, we're changing the rules. That's it. We're changing the rules and your stuff. So, and that's just not isolated to New South Wales. It's all governments right across Australia. You can see, and Queensland, you can see that fortune favours the bold and they're prepared when it comes to property investing. So give me a sense, Damien, sort of staying at this national level as a property investor. You've got population growth coming. You've got the opening up of Australia, bringing in skilled migration. This is all good stuff. My sentiment is that we're probably going to have this government for some time. I reckon it's at least a 2-term government. I don't think it's going to be a 1-term. So, what does that mean? Well, you've got a particular government that sees the world a particular way, which will be sort of leaning more towards being supportive of sort of the collective of Australians, working class Australians, that sort of stuff. I'm generalising. Where would you be putting your bucks nationwide at the moment, Damien, if you've got your crystal ball there, and where do you think you're going to get the best returns over the next couple of years?
Well, I think you're going to get your best returns in some of the lower priced capital cities. The interest rates, whichever way they go, I think they probably should top out here, but they might go up, maybe 50 points more. They'll probably start to come down either the end of this year or early next year, but not by much. We're not going back to the good old days when we're.
So expect to pay about 5% on your mortgages for the foreseeable future for the next 3, 4, 5, 6 years.
Yeah, it'll be between 4.5 and 6. I think it could come backwards a little bit. But the days of 2.5 once in our lifetime, we'll look back when we're old and sitting on our porch, Phil, and thinking about those good old days. We saw that once in our lifetime, and you got to remember the only reason they were that low is because they thought there was going to be an absolutely catastrophic economic downturn, which fortunately didn't happen. So if that had happened, we wouldn't have had price growth in the property. So it's all a bit of a trade-off. So, yeah, you're going to pay, and that's the norm, right? You've been in property a long time, I have, and 4.5% to 6% mortgages is not unusual by any stretch of the imagination. That's always been the norm. So that's why I think rents will go up, because investors, rental yields in Perth, particularly Adelaide, Darwin, are still pretty healthy. Darwin's still well over 5% gross. Perth is about 5% gross. Adelaide's a bit under. But Sydney, Melbourne, the yield's got to 3.6 gross. Now, when you've got to pay, on top of that, you've got to pay property management fees, rates, taxes, all those sorts of things. It starts to make it a bit more challenging when your interest rate's 5%. It was okay when it was 2.5 to 3. So I just think we'll see fewer investors in the near term. And ultimately, with that population growth, rents will continue to go up. So ultimately, then the rents will go up, and that'll start to encourage investors to come back in. So I think where your best bang for your buck is there's always a thing I look at in any market, whether it's stock market, property market, mean reversion. It markets it out. It's very hard. Doesn't mean it can't be done, but it's very hard to be consistently outperforming every other market, whether that be the stock market or the property market. And so I certainly think we're Perth-based buyers agency. We did buy a lot of property in Brisbane 3 or 4 years ago, and that turned out to be a good move. Certainly our markets that we're looking at the moment are, as well as Perth, is Darwin and Adelaide. Darwin's a bit more speculative and certainly more volatile, but look, you'll still go okay in Sydney, Melbourne and Brisbane over the next 3 to 5 years. But I think there's a bit of catch up when the median prices in those markets are 500 to 600, and Sydney's for a house is 1.5 and Melbourne's 1.2 and Brisbane's 760 and Hobart's 820. The balance doesn't seem right to me. And yes, Sydney, Melbourne are always going to be the most expensive. Perth should be more on a par with Brisbane. And certainly Darwin is an expensive place to build and construct. That probably should be in the 600s as well. So I think that's where you'll see a bit of catch up in those. But they're very much fundamentally based on the strengths of their economies, and mining in particular, mining, oil and gas. And if you're bullish on the mining sector, well, then you would say that those markets will go pretty well. If you think we're going to have a collapse in the commodity prices and things are going to go pear-shaped, it's not good for Australia, but not particularly good for those property markets. So you need to understand the fundamental drivers of the economy in those locations.
So a question, I want to go to a break, but I'll ask you this question before we do it. If you're going to recycle your portfolio in this market, and by that, for our listeners, I mean selling off some assets to buy other assets in other locations. So selling off some assets in some locations to buy other assets in other locations. Where would you be selling, and where would you be sort of parking that money?
Yeah, it's a tough question to answer generally. I think the markets they'll probably be the lowest performers the next 2 years will be the big two, Sydney and Melbourne. Okay, that's my take on it. They've got overheated. They're still going to be the most expensive, and they're still very strong economies. But because the average gearing level in those markets is a lot higher, and their income, if you look at the figures that are out there in Deloitte and the National Real Estate Institute of Australia publishes, in New South Wales particularly, that it's nearly 50% of income goes on a mortgage. So you're going to be more interest rate sensitive in that sort of environment. But look, I still think it's got to come down to your circumstances. And when we work with clients, you could have, we generally don't just fundamentally say you should sell that city and buy in that city, because if you had only one property in Sydney and 7 properties elsewhere around the country, for example, we wouldn't sell your Sydney property. It's a solid performer. It's the capital of the biggest city in the country, probably always will be. Melbourne might catch it, but it's a global city. And global cities do get a premium, right? If you look around the world, any coastal global city, California, same problem, same issue, Vancouver, coastal global cities are very, very expensive. So would you sell Sydney if it was the only one? No, you wouldn't. But you've got to look at concentration. So I think, we have clients who have got a lot of properties in just WA, and we do go through that scenario with them and go, okay, well, you're very heavily concentrated in one location. You really need to think about maybe either dialing down some here and going elsewhere, or at least stop here and go elsewhere, because the markets around Australia aren't uniform. You don't want to be in a market that's going to underperform for a long time. We know crystal balls are hard to always see the future perfectly, but I think diversity, if you're building a property portfolio, as you've probably done, Phil, with yours, I'm sure you've spread it around the country. You're not so that if one market's down, well, that's okay, another market's going okay. So fundamentally, I guess Sydney, Melbourne, I think will be the underperformers because of where they are, and the lower price markets are going to do better. But I'm not a big one for recycling, just because you're out 2% sales fees, capital gains tax, 5% stamp duty to get in. It's got to be really a killer. Really like and it's hard to see property, one market going down that much and another market going that much to make sense.
Well, you answered that as I expected you to answer it, Damien. And I think the point being that everyone is absolutely unique. And I was sort of viewing it from my own perspective of going, I wouldn't mind selling some stuff where I've got a lot of stuff and putting in the markets where I don't have. So, and the way I frame that is, say, Brisbane, for example, where I've got a lot of properties. Have I got most of the growth that I'm going to get out of those over the next sort of 3 to 4 years? So do I sort of repark that capital somewhere else where there's growth going to be coming? And this is the question you need to be thinking about and probably asking your buyer's agent or property strategist, whoever you choose to use. Damien, I want to talk about Western Australian market, because I know you know it better than pretty much anyone I know. We'll just go to a quick break. Everyone stay with us. Back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show, with Damien Collins. He's a Managing Director of Momentum Wealth, Chairman of Westbridge Funds Management. Now, it's your backyard, Damien. I know you and your team buy property all over Australia, both resi and commercial stuff. And we'll chat about commercial stuff in a moment and some of the development work that you're doing. But how good is Western Australia at the moment? Because we've spoken at many different times over years. I remember being back on Sky TV with you when Perth markets were tanking and you only had about 10 real estate agents left in that state because there was nothing to sell and no one was selling because it was worth a lot less than what they paid for it. Times have changed for Western Australia. You telegraphed, I would imagine, 2 and a bit years ago saying, not quite yet, but it's nearly there. And Western Australia is certainly there right now. And you think quite a lot of growth to come. You're framing Western Australia from the point you made that it should be an analogue with Brisbane, probably a lot of similarities between the two states. Some would argue that Western Australia is much better, but give me a sense for that side of the world, mate. You guys doing okay?
Yeah, look, it's been a long time coming, Phil. The downturn it was a lot deeper and a lot longer than I think we all then anticipated back 2015 to 2019, which was a little bit painful. But nonetheless, the Perth, for those with really long memories, you might remember Perth in 06, 07 was not far off Sydney prices, and obviously that was an overshoot. And now Perth is a third of Sydney prices. That's, to me, clearly an undershoot. So, look, fundamentally, it's in great shape. Since interest rates have risen, it's basically flatlined, month up a little bit, down a little bit. I think that obviously people just took a cautious outlook. This time last year, people were going in with their ears pinned back. But the market hasn't gone back. We haven't really been hurt by interest rate rises. No doubt some people are reassessing their budgets. But what impacts the WA market more is the strength of the economy. And people move to Perth. I moved from Melbourne 20 plus years ago. It is a market that people move here, even though it's got a stunning lifestyle. If anyone's been here, you'll know it's a beautiful lifestyle. The river, in a lot of ways looks beautiful, like Sydney Harbour. The beaches are stunning. So it's a great lifestyle location, but people generally don't move from Sydney, Melbourne, Brisbane, or the east side of the country to Perth just for the lifestyle like they do. Like people in Sydney and Melbourne now in droves are flocking up to Queensland. They're looking for a lifestyle that's more affordable. Even though Perth's cheaper, far fewer come to Perth for lifestyle. They generally come because there's job opportunities. And that's what drives them here, and many of them will stay on once they've done that. So the unemployment rate, it's interesting. There is more jobs than there are unemployed people right now at the moment. And so many cafes I go to, help needed. It's a tough time if you're trying to recruit staff. So mining sector's just scrambling. They've got so many jobs. Wages are very strong. So that's an important part. We did actually get 10,000 people moved from over east in the last 12 months, which is unusual. Some of them are probably returning, West Australians coming back. But there's certainly the job market here is very, very strong. And we also have a very significant shortage of residential stock. So the Real Estate Institute of WA put out a release with the lowest levels of stock for sale and rent in 12 years. And I saw CoreLogic also this morning put out a release on what's happening in the rental market. They're saying that the rates are decelerating, rates of growth are decelerating everywhere in the country except Perth. So it's actually still increasing the rate of rental growth. So that doesn't surprise me, because the other big issue we've got here at the moment is that the building industry just cannot cope and cannot keep up. And one of the things, and I think it's something for government policy to think about in the future, normally a downturn in a market is 12 months to 2 years. Normally we see that in all markets. So Perth had a downturn of about almost 6 years. And that doesn't just affect the established market. That affects when housing prices are flat or going backwards. People don't build either. They go, well, I don't want to build. I can buy something established. So we saw the hollowing out of the building industry. We lost so many trades. And that's been a real challenge. When things pick up, there's just not the labour around to build those homes. So costs have gone up, timeframes are blown out. People have just put their hand up and said, I don't want to build anymore. In fact, the approvals that came out from the ABS showed that building approvals are heading back to near record lows because people are just going, it's too hard. And so the stock coming through is going to be very low. We had that big bulge that's still getting there from all the grants. But once that gets through the system, there's not enough stock. There's certainly getting built. There's not enough labour to build it. And rents are still going up, and the affordability is incredibly strong. It's our affordability, median house price is $540,000 according to REWA. According to REI New South Wales, the median house price in Sydney is over $1.5 million. So it is very, very cheap. But if China stopped buying our iron ore, that would be obviously won't happen because they can't. They haven't got another reliable source. But it's certainly very much commodity-based economy. That's the driver, oil, gas, but particularly gas and iron ore. But there's lots of new things happening. Obviously, as I do meet with a lot of senior executives in the mining space and just, reading a lot of stuff over the break, which is great, not just for WA, but Australia, to get to this whole battery-driven and renewables economy. The amount of lithium they need to dig out of the ground and sell is 19 times what it currently is. Even copper and nickel, which are long-stay commodities, are 2 to 5 times, I've read articles on. So the outlook is pretty bright. And the mining companies, the mining services companies, I speak to some of the senior executives there, they're talking about they've got pipelines of work of 4+ years in terms of building new plant, maintenance and everything. So fundamentally, it looks very good, but people got to realise it is going to be more volatile and market. It tends to go in different cycles to Sydney and Melbourne. But fundamentally, things are looking pretty good. Yes, interest rates have slowed down, but we've still got that bubbling underlying pressure of population growth and not enough supply. So again, as I said earlier in the podcast, I think nationally, the big X factor is population growth. If we get 235,000, well, I think that'll certainly refuel the East Coast markets a lot more quicker than some of the commentators out there are talking about. And certainly Perth, we've got no stock anyway. That'll just, really, I think, light a bit of a rocket under it. But if we get 100,000, for example, and not 235, well, that's quite a difference in the number of people demanding property, and that will be a dampener. So a lot of moving parts to what's going to happen, but I think the big X factor is the population growth. If that really spikes up from overseas, then I think it'll certainly fuel our property markets much quicker than a lot of the experts out there are saying.
Yeah, and a lot of that is dependent and conditional to the government's attitude towards an ability to streamline processing of visas for new Australians. So that's on our agenda. And to just talk geopolitics for a moment, because to your point, Western Australia is intrinsically linked with the health of the Australian economy. That said, the driver of the Western Australian economy and its contribution to Australia in many ways is its mining assets. The new government, the Prime Minister, Anthony Albanese, met with the Xi Jinping only about a month or so ago. That's not a reset of the relationship with China. Those challenges and competition from a political point of view, geopolitics point of view, still remains. However, I think there's a softening of the rhetoric Australia has with the new government towards China, and that's sort of opening up those at least lines of discussion to have dialogue, which put that in the sense of property markets in Australia, it probably bodes better for Western Australia than other states for the continuity of at least having access to the mining resources that China needs. But the real politic of that is that, irrespective of the relationship, if China needs that stuff, they'll keep getting Aussie companies to get out of the ground and put it on boats up to China. And the COVID sort of policy, now they've opened that up. It means that you have a greater fluid movement of shipping to and from China. So that's opening up a lot of stuff. That's good news for, I'd say, mining industry in Australia, and therefore how that flows into property investment. And, this is the stuff outside of your control, isn't it, Damien? But what do you do about it is good. So if you're going to operate inside of the Perth market, where should you be buying and what you should be buying? The question I have before we go there, Damien, I'm just curious of this. You paint this great picture about WA and Perth in particular. And most people sort of work in the mines. They base their family in Perth. They fly in, fly out, FIFO, all that sort of stuff. Your river's okay. It's not as good as Sydney Harbour, mate. Come on. Yours is brown, ours is blue. Beaches are lovely. Lifestyle's great. Cost of living is really good. You paint this really nice picture of WA and Perth in particular. Job growth, ability to secure a job, keep a job, grow in a job, make income through a job. Yeah, I agree with all your sentiments there. Why aren't people flooding out there on that basis? Is it the tyranny of distance? And I note that London's closer to Moscow than what Perth is to Brisbane, right? It's a long way from anywhere. Is it just too far away for most people? They're happy to stay East Coast because there's an hour and a bit to get to pretty much everywhere you need to go, whereas that flight, that red eye to Perth and back's a long way, mate.
I think you're spot on. It's the tyranny of distance. People, I remember growing up as a kid in Melbourne, and you'd hear stories about people moving, either going to the Gold Coast or they're going to Brisbane. They're moving up there for the lifestyle, and certainly more recent years, I know my parents' generation, the last 10 years, they've had friends who've sold up and gone to Hobart. Yeah, it was more affordable housing. That was their super plan: sell for $2.5 million and buy something down there for 900, and that's all the balance left is their effect. They didn't have a lot of super, so. It's just that I remember watching the cricket back in the 80s, and and 90s, and Perth seemed a long way away, and almost like the sense I think in Sydney and Melbourne is it's part of Australia, but it's almost like a different country over this part of the world. So I think it is. I mean, it's not that common. You say people are moving to Perth for the lifestyle, even though it is a great lifestyle, and it's. Phil, you've come at the wrong time of year. It's very blue for 9 months of the year. It's when the winter rains come that we do get a little bit of brown, but most of it's shiny blue at the moment. I'll send you a picture later.
Okay,
as I drive
happy to be corrected.
As I drive past it on the way home. But most of the migrants come from overseas. In fact, I think over 30% of people are born somewhere else in Perth. They're born from another country. So it's incredibly, if you go some of the northern suburbs, you might feel like you're in the north of England. Lots of English people come here because it's, again, closer than Sydney, Melbourne. And
one flight.
They come for the lifestyle and the job opportunities. So, yeah, it's the most remote capital city in the world. So that's another detriment to it as well. It's which worked well in COVID. We didn't have we could fairly easily keep it out. But, we're a long way from everything. And obviously the modern era of technology and everything makes life a lot different to what it would 40 years ago. But, we just don't get a lot of migrants in Western Australia from over east. I don't think that's going to change. Yes, we did get some in the last 12 months. But most of the growth has always been in WA from overseas migration.
Well, it's not a bad issue. And I know, mate, there'd be POMs lining up right now to get out of the UK because it's pretty dire out there at the moment. Inflation through the roof. It's horrible. So if I rocked up on a Qantas plane landing at Perth directly from Heathrow, I'd have a job that afternoon. Wouldn't be a problem.
If you've got a pulse and you can stand upright, you'll get a job, no problem, Phil. There is that much work out there that there's plenty of opportunities. I think that the problem is the visas has been terribly slow. I think they're picking up on that. And they need to. Businesses are screaming out for it, not just in Perth, around the country.
Well, that's the opportunity and challenges for the government. I think hopefully they're mobilising their efforts to be pumping as many people as possible to speed the processing because it's good for Australia. It's good for Australian economy to actually have. And look, we can cater for more people in Australia. Yes, there is the housing renting issue that needs to be looked at, but this is a podcast for property investors. So we're painting this nice picture for WA. Whether I subscribe to your view that it should be sort of an analogue with Brisbane, it's probably outside of my knowledge of the two markets and the drivers of it, but it sort of makes sense.
Yeah, historically, it's been a lot. Whether it should be exactly the same or maybe within 10%, that's a debate. The average income in WA is higher. The population is slightly smaller in Perth. It's 2.2 mil. I think Brisbane's about 2.6 mil. Sydney and Melbourne obviously much closer to 5 mil. So the average income though in Perth is good 15% higher than Brisbane. So
and that's good going, right? And these people need to live somewhere. So where do you put your bucks as a property investor? In WA right now, you pump it into Perth. You're not dabbling in regional markets?
Not anymore. We were dabbling. We went in pretty heavily into the Pilbara 2.5 years ago. 3 years ago, we've bought well over one of our funds. We've bought 100 and something properties, plus we bought dozens and dozens more for clients, and they're all very thrilled because they're up 50 to 70% in value. So, and rents have gone through the roof. So the Pilbara, we spoke earlier in the podcast about property as a long-term game and not. You don't want to try. You want to pick a good location, and hold for the long run. Not in the Pilbara. You want to make sure you get in and out at the right time. That was the market that went from nowhere to 900,000 in Port Hedland, then back to 200,000. Now we bought most of those properties when the median was closer to 200,000. It's now in the 400 plus ish thousand range. Some of them we're holding, but we're starting to drop a few off. But replacement costs have gone up like everywhere. It cost you 700,000 now to build a house up there. So
700 grand.
Yeah, it's just out of control. That includes the land, but nonetheless, it's pretty expensive. Whereas in Perth, you can still get a house on land for 500 or 515, 520. So I think, look, Perth is we spoke earlier, it's a mining-based economy, and so you've got to wear that volatility. And if you're bullish on the future of the commodities that WA has in spades, well, then that would help. If you think mining's too risky, well, then you might well avoid WA. But if you're going to come into WA, I think as a first-time investor in WA, again, depending on your property portfolio size, then you would I would recommend generally sticking with Perth. Again, everyone's individual in their circumstance. If they've got 15 properties, then you might go into something a bit more risk in in a regional location like Geraldton, perhaps. And in Perth, Perth is a very spread out city, low density. So it hugs the coastline as you go north and south. But there's plenty of properties, in particular, I think around if you've got low budgets, 350 to 500,000. Rockingham, which is kind of like a Frankston, I guess, of if you're looking compared to Melbourne or the Shire, where ScoMo's from, that 40K out of the city. It's on the beach, beautiful part of the world, has been generally more working class, lower price point, but a lot of industrial stuff around on the coast in Kwinana, not far away. But beautiful part of the world. We still like a lot of the northern corridor suburbs, not right on the beach because you're paying for an investor. We're trying to get a good yield. So generally with investment stock, we're sticking from 400 to 600, where you're going to get roughly your 5% yields. Once you get over 600, it starts to taper off. And if you bought a property for 1.2 million in Perth, you're not going to get 1,200 a week rent. 600,000, you would generally get $600 a week rent, thereabouts, depending on the quality of the property. So generally we're trying to buy in that bracket. The freeway system and there's a train system up north. I think Perth has severely undervalued the importance of proximity to transport because we have been a lower density and not so nearly congested as Sydney and Melbourne. People have not put as much premium on that. I certainly know when I left Melbourne even 20 years ago, being close to a train station was really important from an investor's point of view and an owner-occupier point of view because you got around a lot more on public transport. That will come as the city gets bigger and more congested. So looking for those things that have got the infrastructure, there's a new train line out past the airport to Forestfield. I think that's a very undervalued area in the foothills. It's, again, in that sort of 400 to 500 range, 14K from the city as the crow flies, train line directly there. So there's plenty of opportunity. If your budget's 350 to 600, there's plenty of opportunity in Perth. And you generally will get a house. You won't need to go to a townhouse or villa or apartment. You can generally get a house in a pretty decent suburb, particularly if you've got 500,000 or more to spend.
Right. Well, you've heard it there directly from the guy that knows. Some good insights, Damien. And I know you sort of operate inside of supporting individual investors by Australia-wide, but we're talking specifically about Perth. But you also have your funds management business. You mentioned funds that have been investing in Pilbara resi housing. I'd like to sort of dig into that a little bit more. We'll just go to a quick break. Stay with us, everyone. Back in a moment. Welcome back, Phil Tarrant from Smart Property Investment, chatting with Damien Collins. Now, Damien, tell me about Westbridge. How are you guys going? I received a prospectus from you guys. I haven't done anything with it, but last time we spoke, I'd like the sound of what you guys are doing. Any new funds, different scope? Because by memory, you're going to test me on this, but you and this to work out whether or not I listen when I podcast. You sort of have three different sort of funds with different philosophies, sort of growth funds, more stable funds, that are stuff that's a bit more risky. Did I get that right?
You're pretty spot on, Phil. Well done. Well done. Look, we set up the funds management arm predominantly because, look, residential, most people want to touch it, feel it, do it themselves. And generally with the ability to borrow 80%, all those sorts of things, negative gearing, most people can get into an individual residential investment property and build their wealth that way. But my philosophy on this is always residential is a great place to start your investment journey, but it's not where you should end up. When you get to 65, 70 or whatever your retirement number is, you generally want to live off the cash flow from your investment properties. Now, resi, we spoke earlier there, resi at the moment, the gross yields are maybe 5-ish% in Perth and some others, Darwin, but in Sydney and Melbourne, the gross is 3.6, the net's probably 2. And if you've paid that off and you've got, let's say, $2 million of property with no debt in Sydney, your probably income is $40,000 a year. That's not a lot of money to live on. Whereas in a commercial sense, commercial space, you could potentially have a net income particularly through a fund, you might have a net income of 120 to 140,000 a year. So it's a huge difference. So an ideal portfolio for us in our strategy is blended half and half in residential direct, and the other half in, depending on your risk tolerance and other things, in other classes of assets that generate a higher return. Now, the reason for syndication is these things are very expensive to get into. We buy commercial properties from 10 mil to 60 mil, and in those ranges. And that's the issue with commercial. It's not easy to get a good quality asset. You can't just go and buy a good quality commercial for $500,000. They're generally going to be pretty rubbish tenants. And so you need to buy better quality ones, and that's out of the reach of most people. And even we've got clients, some of our clients are worth 500,000 in that syndication space, and some are worth 150 mil. Even the people with a lot of money you're going, well, I could buy a $20 million asset on my own, but you know what? That's pretty concentrated even for my portfolio. I'd rather stick in $2 million across 10 of your funds or other funds as well and spread my risk around. So that's what was the premise for it. It was commercial property and also development opportunities that people couldn't get onto on their own, but syndicated fund. If you buy 1% of the fund issue units on, you effectively own through the fund, effectively 1% of that property or development. So, and we've set it up. There's based on the different risk tolerance. So we've got passive funds, multi-asset funds. So we're buying property all around the country and great quality tenants, lots of different properties in those funds and generating a stable, nothing's guaranteed, of course, anything can happen, but by spreading that risk around, we're generating 6.5% to 7.5% returns to investors, hopefully capital growth on top of that. Of course, that's not guaranteed. And that works beautifully for a lot of our 70 plus investors who are going, or 65 plus are going, I want to go and play golf, do what I want to do, and I'm just getting that monthly distribution. You guys manage all the assets. Then we have some other ones in the little bit more risk, what we call our total return funds. We're about to launch one very soon now. So if you want to know what that's about, go to westbridgefunds.com.au and put your details there and we'll put you on the list. But that is where there's some value add to it. So the one we've bought, I won't be able to say just yet the location, but it's a pub that we're good relationship with the tenant. They're in some of our other deals that we're going to do some value add to that, put in beer gardens and other things. And we're agreeing with them on a rental return, but that we'll expect to see a little bit lower cash flow, but quite a value uplift. And that's a total return fund we're targeting 4-ish years, where we will then get the value uplift, rent it, they'll extend the lease for another 10 to 15 years, and then that'll go back to market and we'll resell that at some stage. So that's a bit more, but does come with risk. And got to get development approval and building cost risk and all those sort of things. But you're generally targeting total returns, including capital uplift of 12%. Again, not guaranteed and certainly carries more risk than that passive asset. And then at the higher end of the spectrum is our development funds, where people are putting in money like it's normal. If you're doing a development yourself, you buy the land, you get your development approvals, you build it, you're selling them, and it can take, depending on the 2 years to 4 years, depending on where the stage of the development's at. Generally, you're targeting 18% return per annum, but the difference is in development, it's all lumpy right at the end and carries a lot more risk. I certainly go, anyone in development, you shouldn't be putting anything in there you can't sleep. That's going to make you lose sleep because building costs have gone through the roof, as we've seen. So that's means some projects do have to get shelved and put in the drawer. Other projects we got in at the right stage, we developed, we knew the market was moving and we're going to get much higher returns because we built them without pre-sale. So you've got to look at what your risk tolerance is and don't put all your eggs in one basket. That's the beauty of funds. You can spread it around. You don't have to, I've done a lot of developments myself over the years and most have gone very, very well. But, you occasionally get that one that everything go out of your control. Things go wrong, the market, the builder, all those things. It's a lot of eggs in one basket.
You've got to expect it. You've got to expect that stuff. And in terms of inflationary risk, whether we're gone through the worst of it, sort of spoke beforehand around sort of transport opening up sort of globally, getting stuff moved around, already chatting with builders, some building costs are coming down. Are you seeing those things softening a little bit?
In the construction market, the front end is definitely softer. So the builders, what we had in certainly the second half of 2022 was people were getting shocked and constantly shocked by the increases. And so we had the builder put on a premium for risk. The subcontractor who was putting in a premium for risk, everyone was putting in risk premium. And what we're seeing is the back end is still quite active in terms of the finishing trades. So your cabinetry, your plastering, your painting, they're in that zone at the moment where generally around the country, it's slightly different by capital city, but generally they're in the zone at the moment where they're very busy. So the prices in that sector are quite high. But we have definitely seen prices coming back in the bricklaying space, in the concrete, the structural component. So if you look at the building approvals, I mentioned earlier, WA's, right down near 1,000. All the ABS put out the stats, second month in a row that approvals are dropping off dramatically. So that will eventually flow through to less work. So prices, Phil, tend to be sticky. It's not, you go and talk to your average carpenter or a bricklayer and they don't like going backwards. They like going up in their prices. It's only when they get a little bit desperate that they'll start to cut. Yeah. So we're not going to go back to prices of 2019. That's gone. But could we see 5 or 10% drop back? Potentially. And I think we could also see maybe shave off a little bit more because I think that risk premium will come out of the market. Builders go, It's a tough gig being a builder. I would not want to have been a builder signing contracts in 2020 and trying to build, or 21 and trying to build now. It's a tough gig. They make their turnovers are huge, but their margins aren't very high. So, I think we've seen the worst of construction pricing. How quickly and how much it comes back is yet to be seen. So the inflation's coming out of that. Building approvals are off. I noticed even the other day, I don't normally pay attention to the petrol price. Well, that's not too bad, actually, the petrol price.
I had the same thought on the weekend where I went, it's come back 10 cents. And again, this is all connected with a lot of the building costs. Yes, there's materials, time and materials, right? Any building contract.
Yeah.
What do you need to build and who do you need to build it? On the who do you need to build it, as we get more skilled migrants into Australia, that should help at least stop prices going up, which means you're going to have more talented people, builders doing the job, which means supply and demand. They're going to have to get a little bit more competitive over time. So that's all good. Now, Damon, let's round out with this quite a wide-reaching chat. Probably one of the reasons why people like the discussions we have with you, which we like to do as quite regularly on the Smart Property Investment Show. Key advice for 2023. What's the key to success for property investors this year, mate? Sounds like a university thesis.
Key to success. Well, the first thing is that I still believe 2023 is a year of opportunity. The cheap markets, I still think, yes, they won't do great things in the first 6 to 9 months, but I think fundamentally they will get re-rated. And you will have the opportunity in the bigger markets where we might see a little bit more price declines in the next 6 or 8 months. You'll have opportunity to really lock away a really good property in your portfolio, and you're going to have to pay the silly prices. If you bought in 2021 and you're competing against lots of people, you'll find you'll be able to buy those properties without as much competition. So certainly it's the year of opportunity. I think for a lot of investors, particularly if you've already got a bit of a residential portfolio, my advice is to think about things. What's the end goal of buying investment properties? It's not to drive past 10 of them and tell your friends and family how well you're going. Ultimately, it's a source of money and income for the day when you decide, I don't want to generate income from other areas, whether that be business or your wage, what that might be. So the key advice is to think longer term. So if I'm looking to go retire my portfolio, well, is residential going to do it for me? Given the yields are a lot lower, net returns are a lot lower, do I need to think about maybe putting 5 or 10% of my money in something that's going to generate much higher returns? Yes, it's riskier, but it's not all my eggs in one basket. And maybe do I need to start looking at commercial? Our model portfolio for a person building a property is 50% residential, 50% commercial. Residential safer, generally less volatile, going to give us lowest returns. We should aim to get net 3 to 3.5 out of that. Commercial, we aim to get net 6.5 to 7, but that 50%. So the blended rate we get is a net return of 5% across that portfolio, maybe a little bit of development stuff in there as well to top that up to get us to maybe a bit over 5. So that's the key advice, is a year for opportunity, certainly in the residential market, but you don't have to buy tomorrow. And my other key advice for investors is think outside the square. What's the end goal and what is the property types that are going to get you there? Is it all really just residential property?
There you go. Thanks for your time, Damien. Always enjoy the chat. We've covered a lot of ground there. We'll see you back on the Smart Property Investment Show soon. If you're in Sydney, mate, make sure you check in. Say good day. Say hello. I know it's a long way.
No, I will do, mate. I will, and I'll come up to. You're still in North Sydney, I believe. So I'll come and
say good day.
And I want in person. And I know that it's an audio podcast, but I want one of your T-shirts with the.
Mate, I'll get you one. I'll do that. You've got the merch.
I'll come and get the merchandise.
Come get the merch. It's Damien Collins, Managing Director, Momentum Wealth, and Chairman, Westbridge Funds Management. Go and check these guys out. Was it westbridgefunds.com.au? Is that what you said? I got that right? Okay, cool. And you can just Google Momentum Wealth. You'll find these guys pretty easy. Thanks for tuning in, everyone. Remember to check out smartpropertyinvestment.com.au. Quick favour for me, if you can keep those reviews coming on whatever podcast player you're tuning into, this team get a real kick out of it, that it's working for you. Social media, Smart Property HQ is where you'll find us. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Have you signed up to HR Leader? Go to hrleader.com.au to subscribe. Receive the latest HR and people leadership insights and news.